Welcome to the Market Recap, your weekly digest of the biggest market stories from the past week. Join host Anna Serin and financial expert Bruce Campbell as they go beyond the headlines to deliver cutting-edge insights into news that move the market. Proudly presented by the Canadian Securities Exchange.
Hi, my name's Anna Serin, and I'm Director of Listings Development with the Canadian Securities Exchange. You're joining us for yet another market recap on Friday, June 3rd, 2022. I am not joined today by Bruce Campbell, but yet again, Jordan Youl with Stonecastle Investment Management. Thank you for joining me, Jordan.
Yeah, it's good to be back. Thanks for having me.
It's always nice to have you back. Listen, there's lots to break down this week, so we're going to just dive right into it. We talked about this last week, so I'm glad you're here again this week, Jordan. We talked about a bear market rally and what that was. We're going to talk about what happened on a search engine this week with looking up bear market rally. Maybe we started that trend, Jordan, you and I. We're going to talk about where we're actually at in the economic cycle. I think most people understand that the, economic cycles, they have kind of their ebbs and flows. You're going to explain where we're sitting in it currently. We're going to talk about ESG. You've probably heard the word ESG lots over the past few years. We're going to talk about what's going on for that. And then, of course, we're going to get into some CSE issuer news. So let's start off with a bear market rally. So remind our listeners, what does that mean, first of all?
Yeah, well, first and foremost, the equity markets in general year to date have drawn down by a considerable margin off their most recent peak. And effectively, the markets did hit a new low a couple of weeks ago. And, last Friday when we spoke, we effectively broke that 7-week losing streak where effectively the S&P 500 had been down for 7 weeks in a row. We had a pretty remarkable thrust in the markets where we had a pretty big up move last week. So effectively, we broke that very rare losing streak. But unfortunately, this week, Monday being a stat because of Memorial Day in the U.S., so it was a shorter week for the U.S. markets. But we're not really seeing any follow through this week. It's intraday right now, but it looks like we're going to have another losing week in the equity markets.
Scary stuff. And so what happened on the search engine?
Yeah, so we do have a chart, and I'll just have Neil post it up. But effectively, on the left-hand side is a Google Analytics tool where effectively it tracks searches for bear market rallies. So without question, it's definitely top of mind for investors these days. We don't know if the low is already in from 2 weeks ago, and we are going to continue to try and test new all-time highs and continue to move upward and onward, or if this is just a counter trend rally where effectively we've gone down so much so quickly. We had a recovery or a counter trend rally last week, but again, this week we're having very little follow through. So effectively right now we're at levels last seen during COVID, March 2020. Now from a contrarian standpoint, this is quite bullish and opportunistic, but from a sentiment perspective, it's really challenging for investors to use as a timing tool because investors can be quite pessimistic for an extended period of time. So effectively, a better way of analyzing this is by taking a weight of the evidence approach. So on the right-hand side is our macro risk assessment model. So when there's a lot of news and cross currents that are taking place intraday and week over week, it's best to take a look at the longer term trend and narrative right now. So with our macro risk assessment model, we're still in a neutral defensive market environment. So what we're looking at is a lot of different fundamental factors that include different sectors, sentiment, volatility, different asset classes, and we put it all together and it assigns a scoring. And right now it's -39, so it falls within that neutral defensive band. But the takeaway here is that we want that needle to start moving to the right and get back into positive territory before we get the all clear for the equity markets.
Well, that's really interesting. Is that part of your practice to look up keywords and what's being searched out on websites?
It's part of it. It's something to be cognizant of. There's other polls like the American Association of Individual Investors that track a number of individuals to determine whether or not they're bullish, bearish, or neutral on the equity markets. We prefer to actually track the fund flow. So the North American Active Investment Manager Index yesterday came out. It's at a 33 right now, which is quite low. So in other words, the pros or the active managers, the large pools of capital do have an oversized weighting towards cash right now. So they're not fully invested. And we also like to look at RIDEX fund flow. So it's one thing to, follow search engines and polls. We actually like to see what people are actually doing with their money. So we actually like to track the fund flow instead.
Very interesting. Well, it's a good thing people are looking it up and educating themselves. On that note, where are we currently standing in the economic cycle? If you want to give us just a really quick high level kind of the tops and the bottoms of it, but where do we stand within it now as well?
Yeah, absolutely. So I have a chart showing the stages of the economic cycle. I think visuals definitely help. On the left-hand side, there are about 6 stages of the economic cycle. And effectively, as an investor, we always want to know, well, where are we in the economic cycle? Are we expanding? Are we topping out? Are we contracting? Are we at the lows? And that really helps with our risk profile in terms of our equity allocation, but also creates an opportunity set for where we want to be overweight, depending on the stage in which we're in. So on the left-hand side is a breakdown of the 6 stages of the economic cycle. And effectively, right now, we look to be in stage 5. And what that means is, commodities as an asset class continue to lead. So in our asset leadership model, we continue to see energy and commodities outrank cash and fixed income, and other equities, including foreign equities. So we continue to see commodities lead, whereas equities and fixed income continue to wane. So that's highlighted in the annotations on the chart on the left-hand side, and why I believe that we're in stage 5. And this current market environment is textbook. So what it means is that the economic backdrop is starting to slow down. So we saw a lot of economic news come out today. The US unemployment rate increased to 3.6. The ISM non-manufacturing index declined. So, and other variables such as the US LEI index is another comparable. It declined last month as well. So we're starting to see weakness in growth from the economic standpoint. But what's really interesting on the right-hand side is if we are in a rising rate environment, which we are, there's upward inflationary pressure and the economic backdrop is starting to slow down, that is textbook stage 5. So we could be at the top of the economic cycle. Now, having said that, there are sectors that thrive and perform very well in stage 5. So on the right-hand side, as we're topping out, you can see materials, energy, consumer staples, and US healthcare. So it's a little bit of a barbell approach. We're seeing larger cap defensives do well, but we have that commodity leadership. So that's why I believe we're early stages of stage 5 in the economic cycle. So, there's a lot of questions about, is a recession imminent? With the US yield curve inverting last month, there's a lot of narrative and noise out there, but, by taking a longer term view, and taking away the evidence approach, this is a really clear visualization of, kind of where we're at, what the expectation is moving forward, and where we want to be invested over the months to come.
Where we want to be invested, and once we reach that peak and it starts to make its way back down, where the investment opportunities will lie, like you said, for long-term investors. Because if you're buying when it's down, there's great opportunity down the road if they're good fundamental companies. Okay, let's talk about ESG. So I feel like ESG has been coined, a word that we talk about a lot. I'm not really sure how much people understand of its impact on capital markets, but it's quite big these days. It basically stands for environmental, social, and governance practices in a company. It's over the years attributed a lot to investor sentiment. People are they're curious what programs companies will have in place, especially, let's say, for instance, the mining sector. ESG is probably where we first started hearing the term, because it specifically had to do with environmental impacts on the property where they were doing their mining. So that's where it really first started. But we're actually now seeing this in absolutely every sector, right?
Yeah, absolutely. Different industry groups and different sectors. We've seen exponential growth in ESG ratings, where issuers and companies specifically have been assigned a rating of the ESG, but also from a product standpoint as well. A lot of ETFs have been created as a result of this, and this has created a niche investment opportunity or a vehicle for investors that specifically want to be invested in companies that prioritize, ESG. Right. So it's definitely a narrative that's been growing. We've seen tremendous growth over the last 3 years, which is fantastic. But what's really interesting and what has really stood out is we've seen record negative fund flow or outflow. This past month, we had over $2 billion of money flowing out of ESG investment vehicles.
Yeah, and I think probably, and tell me what you think here, but I would imagine the reason for that is not because investors are abandoning the idea of ESG, but in moments like these, it's not the most important. Stability is number one. Is that right? So all of a sudden ESG kind of, it's important, but not as important, so I can safeguard my investments. Would you say that's the reason?
Yeah, that's definitely a factor. There's a couple reasons. At first glance, in the context of ESG equities, as an asset class, equities remain out of favor, and we're in a bear market. So we're going to see weakness as a result of that in itself. But also, secondary, and to your point, investors want to make money. So ESG comes secondary. If you look at the S&P Energy Index, it's up 59% last time I looked on the year to date, whereas a lot of the ESG issuers have underperformed. And, traditional benchmarks don't factor in ESG. So if you're looking at making money, investors are looking at, where do we go from here? And really what's been performing has been predominantly energy so far year to date. So I think it's a little bit of a mix between the asset class, but also, trying to make money in this challenging environment.
Well, and I think Bruce has brought this up before. I mean, this is another consideration, and most investors who, prefer to invest in companies that have ESG programs, they're expensive. They're capitally intensive, depending on the sector and depending on what that ESG program is revolved around. I mean, especially in the mining sector, it's expensive to implement these programs. So I think also people are looking for probably the largest opportunity for margin, the largest opportunity for upside. And if all this extra money is flowing or capital is flowing to an ESG program, so it's important, but in these times, maybe it's not the number one priority.
Right.
Which you can say about a lot of things in these types of markets.
And just to
Sorry,
add
go
to
ahead.
that, and just to add to that as well, in terms of the cost, there have been recent polls, and there's been a little bit of a disconnect between what the issuers say they were going to do from an ESG perspective and what they're actually doing. And that's turned off a lot of investors as well. Back in mid-February, there were dozens of issuers and even some funds were stripped from their ESG rating because there was a disconnect between their ESG initiatives, what they said that they were going to do, and what they've actually been doing. So that could have potentially been turning off investors in the ESG space as well.
Well, and that's unfortunate to hear, because the last thing you want is something that's been implemented to create socially responsible investing to lose its integrity in the process. So hopefully that comes to an end. Okay, we're going to get into some CSE issuer news. I'm going to start off by talking about an issuer that we have with us. The stock symbol is GLAB. It's Gemini Labs. Gemini Labs, and I wanted to talk to you about this. I'll explain a little bit about who they are. They're lab quality testing for not only COVID or flu, but also applications in health and wellness. Biosensing can be used for preventing disease. They have an easy to use, easy to scale, and sell testing that overcomes supply chain bottlenecks. Not to mention their chief science advisor was the co-founder of Clear Blue Pregnancy Testing. It's a name that's been around for a long time and a very well-seasoned management team. This is a great company on the CSE. I've really enjoyed watching them. They actually will be in Calgary next week at the Petroleum Club meeting meeting with investors. If anyone has an interest in checking out more information about them and meeting the team, you can email Julie at marketmotionmedia.com to see if you can get a spot if you're in Calgary next Wednesday. But I wanted to bring them up, not only that I just think they're a great addition to the CSE family, but one thing we haven't talked about, Jordan, is issuers in these markets in the past few years that have gotten involved in the COVID arena, so to speak. What are your thoughts on these? I mean, these guys they've completed some human trials. They're on their second human trial. They've been given patents. These guys are pretty far down the road. Have you seen lots of companies come to the capital markets in the COVID arena?
Not a lot, but I think that trend's going to definitely pick up. I think this company in particular has definitely set the bar quite high. And as you mentioned, with their patient results from their studies and tests, I think they did about 500 patients, and it was very favorable. And they just got a nice rating. It's a CE mark, effectively. So yeah, they're definitely setting the bar. And I think obviously, as we continue to live with COVID and these variants, rapid testing is going to be very important, right? And we want the results to be effective and consistent, which is really important. But yeah, I think this is early stages of a bigger opportunity for companies that want to get into this niche market.
Well, I know when COVID first came down, there was a lot of concerns of companies, mentioning COVID in their press releases. And so it's kind of nice 2 years down the road to see, Gemina especially. I mean, it looks like amazing work that they're doing, but to see, some real companies come to market in the space, because like you said, this is something that we're going to be dealing with on a go forward basis. Don't see it going anywhere anytime soon. So again, they're going to be in Calgary next Wednesday. If anyone is interested in going, you can reach out to me or Julie at marketmotionmedia.com to go and hear more about them. Further to that, CSE news in general, I just wanted to mention we've had lots of discussions. We had VRIC in Vancouver. I have some great interviews that were done with David Rosenberg and Danielle DiMartino Booth. You can check them out on CSE TV. We are now moving into the PreDAC portion of the year, which is normally earlier than this, but now we're enjoying it in June. We will be hosting our annual PreDAC event in Toronto on June 8th at the Pilot. You can check out the information on our website, where you will hear everything pre-DAC. And then, of course, we'll be at PDAC. We will have a booth on the floor. Please come by and see us if you're going to be there. We'd love to see you all. The whole team will be there. If anyone wants to have meetings, please let us know. I'm happy to get together. We'll also be holding our annual investor luncheon where you can hear CSC pitches. We're also putting together really interesting, and I wanted to make sure I brought this up. Apparently, there are some proposed changes coming down the pipeline for 43101s. This is the technical document that mining companies need to go public. And it obviously came from the fallout of BRIEX. And so there's some proposed changes that will affect issuers. It will affect investors. And so we're gonna get a group together and we're gonna talk about what those proposed changes are and how they affect issuers. Obviously for these little junior exploration companies, these added constraints just make it harder and harder, right, Jordan?
They do, yeah. From a compliance standpoint as well, it just puts a little bit more time and pressure and costs on the company. But yeah, it's important though. You want to have the regulations in place because from our perspective, we think we're in this new commodity cycle. Where the markets are showing similar characteristics to what we saw in the early 2000s, where this could be a multi-year opportunity for commodities. We've seen that in the copper miners and some of the precious metal issuers that are performing well this week. And we think if everything can be in place as we are in the early innings of this potential new commodity cycle, I think, it's a great opportunity set for investors.
Absolutely. And protects stakeholders from all sides. Jordan, what should we think about going into next week?
Yeah, well, I think what's going to be top of mind for investors, and it's probably already priced in to a degree, but the Fed is expected to increase rates by 50 basis points, but that's going to be on the 15th, not next week, but the week after. I think that's really what's going to be top of mind. We'll continue to see a lot of economic data coming out next week. But effectively, what we're going to be doing is we're just going to take in all the information, put it into the models, and we'll adjust our allocation and narrative once we start to see the needles moving in the right direction. Because at this point, there's a lot of cross currents taking place, and we're not out of the woods yet. And it's really not that encouraging to see the fact that the markets are not having a follow through week after last week. So we'll just take it day by day, process the information, and then go from there. But given where we're at in the economic cycle, and with all those sector rotation that's taking place, there is still money to be made right now for investors.
Well, I'm just so happy that I have you and Bruce to hold our hand as we go through it. Listen, Jordan, thank you so much. It's always such a pleasure to chat with you. We might see you or might see Bruce next week. We're not sure. Either way, it makes me happy. Thank you so much for all of your insights, and have a wonderful weekend.
Yeah, thanks. Same to you.